Welcome to Financial Oversight. This is Unit 6 in the training series, Being the Best Community Action Board. The Community Services Block Grant Law requires a CSBG-funded entity to have a tripartite board that fully participates in the development, planning, implementation, and evaluation of the program. This is the first of 3 units in which we are going to look at the board's responsibility for evaluation. Information Memorandum 82 lists financial management as one of a board's 9 fiduciary responsibilities. Oversight of organizational finances is sometimes mistaken to be the only board fiduciary responsibility. The list in the memorandum, however, suggests a broader stewardship interpretation of fiduciary, meaning that the board is acting in the interests of another party, person, or organization. In this unit, we are going to look at the board's responsibility for financial oversight from the point of view of the 3 challenges that we discussed in Unit 5. What does the board need to know? How does the board obtain that information? How does the board make sense of that information?
What does a board of directors need to know about financial management? We're going to look at 4 key questions. 1. Is the board receiving accurate and timely financial information? 2. Is our organization playing by the rules? 3. Has our financial condition changed? Do we expect it to? 4. Are we good stewards of our assets? Financial reports are usually dated as for the month ending. The month referred to needs to be the month before the board meeting. The financial information the board receives should not be more than 30 days old. The board should not receive revised or retroactive financial statements. Revisions or corrections should appear in the current financials and be explained by the finance officer. The board receives financial information primarily from the finance officer, who obtains it from the accounting system. Accounting system reports print out a standard format. They tend to be long on detail, but short on explanation. The finance officer needs to do more than present the numbers. He or she needs to explain what the numbers mean. Prompt reconciliation of bank statements also assures the board that its financial reports are up to date. Reconciled balances, of course, also have to be entered into the accounting system. If bank statements are not current, the board cannot know its financial condition.
The board needs to understand whether all of the financial information is produced by the accounting software. Information not in the accounting system creates chances for mistakes. Procedures to incorporate information from outside the accounting system need to be carefully documented and explained. The finance officer needs to explain why some financial information cannot be kept in the accounting software. The board needs to understand why the accounting software doesn't produce all necessary information. One possibility is that all of the specialized software modules that expand the system's capabilities may not have been purchased. This is sometimes seen as a cost-saving approach, but it has the effect of reducing the usefulness of the software package. Complex, expensive accounting systems are powerful financial management tools, but many of their capabilities may not be needed. Finance staff can be tempted to create unneeded, complicated functions. Staff time and training fees to master such a system can end up being more expensive than the software.
Fiscal policies and procedures are subject to many laws and regulations. These are the playbooks with the rules for handling money and other assets. Financial policies and procedures need to be kept up to date with Federal Office of Management and Budget regulations for financial management, your state's financial administrative rules, and your auditor's recommendations about generally accepted accounting practices. 3 primary sources tell whether the organization is playing by the financial management rules: Your finance officer should recommend fiscal manual revisions to the board based on any changes in financial management requirements. Your auditor should suggest recommendations about accounting practices. Monitors from your funding sources give the board feedback on how well the CAA has applied their specific financial management requirements. The board's finance committee can also develop and carry out tests of some key financial practices. Interviews of financial staff can compare whether their actual practices match the procedures in the fiscal manual. Those interviews can also establish whether enough separation of duties exists. For example, the same individual should not be able to make bank deposits and do the bank reconciliations. Similarly, one individual should prepare check requests and another should print or issue the checks.
The Finance Committee should verify that payments to employees follow policies and procedures. Particular attention needs to be given to employees paid from multiple sources. Your Finance and Human Resources officers and your auditor must ensure that employee time is documented legally. The Finance Committee should test a sample of employee timesheets to verify correct procedures have been followed. Claims for employee reimbursement of travel expenses should be tested. Expenses must be properly documented. Claims must be promptly submitted to the Finance Office. If employees can receive travel advances, this oversight is especially important. In the same vein, the Finance Committee should review all non-payroll payments to the executive. All such payments should be approved by the board chair in advance. Credit card transactions should receive regular attention by the Finance Committee as well. The opportunities for fraud and abuse increase along with the number of employees permitted to use credit cards. Finance Committee members need training so they can understand financial management policies and procedures. This will enable them confidently to compare actual practices to the financial rule books.
The board needs to know when financial conditions change and what change means for the organization. The finance officer must inform the board promptly if financial conditions change. Those changes can take many possible forms. Assumptions made when budgeting may become obsolete. Health insurance costs, for example, may increase more than expected. The number of participants in a new program could fall short of the forecast. The price of gasoline could spike. Extreme weather often interrupts basic services, such as electricity or transportation. This makes service delivery more difficult for the CAA. On the other hand, such conditions probably increase the demand for services. Equipment failure can jeopardize services as well. A bus breaking down would be very disruptive to a Head Start or transportation program. A server failure could threaten many years of financial records or client information from a dozen programs.
Of course, changes don't have to be negative to be disruptive. The opening of a new business in the service area could result in jobs for many self-sufficiency program clients. A good thing for the fortunate individuals, but it would require the CAA to launch a publicity campaign to attract new participants. Distribution of ARA funds in 2009 and 2010 demonstrated that new funding can lead to a very accelerated push to find facilities and acquire equipment.
So how does a board make sense of its financial condition? Program managers build board understanding by explaining their budgets. Budget categories and line items make sense when the goods and services being purchased are described in detail. Budgets also show a board when multiple sources of revenue support a program. A brief summary of key facts about a program can be attached to funding requests. This helps board members connect money to services, to people, to changed lives. Cheat sheets with definitions of important financial terms help members make sense of financial presentations and documents. Board members should never hesitate to ask for more understandable information. Finance officers should train board members on interpreting basic financial reports. Briefings could be presented at each meeting. The board could increase its financial intelligence through trainings, conference workshops, and consulting services. Most importantly, the board should create a knowledgeable finance and audit committee that can explain financial information to the board.
Your CAA's financial management occupies a central place in your organizational well-being. Effective financial oversight by the board requires strategies that go behind the numbers. The board needs to have confidence that the numbers are reliable. More importantly, the board needs to understand what the numbers mean. Is your CAA financially healthy now? Will it be financially healthy in the future? In Unit 7, we will look at strategies for the board to exercise oversight of the CAA's programs and services. Until then, thank you for your attention to this presentation and for your service on your Community Action Board.